Ever had a supplier deliver the wrong items? Or worse, charge you for goods that never arrived? Weak receiving controls can drain your profits, create stock errors, and even invite fraud. In this video, I'll show you how to tighten your receiving process, prevent costly mistakes, and protect your business from supplier disputes and HMRC headaches. Stick around, the risks and the solutions might surprise you. Welcome to Accounting Best Practices UK, the channel where we simplify accounting and internal controls for bookkeepers, students, small business owners, and finance leaders. Today's topic is receiving controls, the vital but often overlooked step that makes sure your business gets exactly what it paid for. By the end of this video, you'll know the key controls to stop errors at the loading dock, catch fraud before it hits your books, and build a rock-solid audit trail. Receiving is where your purchase orders meet reality. It's the point where goods physically enter your business. Done properly, receiving verifies that the right items in the right quantity at the right quality have been delivered. Without controls, you risk paying for goods you never received, stock records that don't match reality, staff collusion with suppliers, and VAT reclaims that HMRC could deny. Here's the bottom line: strong receiving controls protect your cash, your compliance, and your credibility. Let's break down the risks of weak receiving processes. Overbilling. Suppliers invoice for more than was delivered. Short shipments. Boxes look full, but quantities don't match the order. Quality issues. Goods arrive damaged or defective, but get signed off anyway. Collusion and fraud. Employees and suppliers working together to skim deliveries. Audit failures. No paperwork linking POs, receiving reports, and invoices equals no VAT recovery. Here's a reality check. If HMRC asked tomorrow, could you prove that every invoice matched a physical delivery? If not, you've got a control gap. The golden rule: never accept deliveries without matching them to a valid purchase order. If there's no PO, goods shouldn't be received. This single rule prevents unauthorized or fraudulent deliveries from slipping in. Don't hand staff the supplier's packing slip when checking goods. Instead, use a blind count. Staff record what actually arrived before comparing it to the PO. This stops rubber stamping and forces accurate checks. Always check condition. Broken, expired, or damaged goods should be refused on the spot. Train receiving staff to look beyond the box and verify quality as well as quantity. Separate responsibilities. The person who proves the PO shouldn't be the one who receives the goods, and the person recording the stock shouldn't also approve the supplier invoice. Segregation creates accountability and stops collusion. Every delivery should generate a receiving report. This document details what was received, by whom, and when. Attach it to the PO and supplier invoice for a three-way match. Digital systems like Xero or Approval Max can automate this step. Finally, control the physical environment. Deliveries should be received in secure, supervised areas. Limit access, use CCTV where possible, and don't let goods bypass checks. Physical security is the first line of financial control. For UK businesses, remember, VAT input claims require evidence. If the quantity on the supplier invoice doesn't match your receiving report, HMRC can deny the reclaim. Also, keep an eye on imports. Customs documentation must align with what's actually received, or you risk delays, fines, or compliance penalties. Receiving controls might sound like warehouse admin, but they're financial controls that protect your bottom line. Get them right, and you'll stop fraud, reduce disputes, and stay HMRC ready. Next time, we'll cover billing and collection controls, how to make sure your invoices are paid faster and disputes don't drag on. If this video helped, hit like, subscribe, and comment below. What's the biggest receiving error you've ever seen in your business?